portfolio value, but then there was also one that came out with the email which said when to use a mortgage agent services as you maximize your real estate portfolio. So this presentation is 10 slides, the other presentation is 1. Always. Simple. Always use a mortgage agent. Sorry. There's one reason. That's the reason. As mortgage agents, this is 16 of the some odd 40 lenders I have access to. So that's why you use mortgage agents, mortgage brokers, because we can take your unique situation and apply it to whichever one of our lenders has a product that fits for you. I don't have to fit you into my product. I can fit the product to you. So that's why mortgage agents, mortgage brokers are kind of your key as you're working on your portfolio and growing your portfolio because of what we have access to. So that was the 2-minute presentation, and then we'll go on the rest of the presentation. So what defines value? So if we're trying to increase the value of our portfolios, it's pretty simple. Increase your equity and more properties. That's how you grow the value of your portfolio, right? Whether it's 1 property, 10 properties, 20 properties, the more equity you have, the more you can refinance, buy another one, and grow your portfolio as you go. So everything we're doing in real estate is around this basis. Get more value, whether it's the property and renovate, force value that way, refinance it, all different types of things like that. Today I'm going to go over a specific product that we use. It's funny, where is it on here? These were crisp lines at one point in time. So we're going to go over a specific product that I use with a lot of my real estate investors that helps us do some of this stuff. So I don't know if any of you have heard of the Manulife One product before. It is a home equity line of credit, which is basically all-in-one banking. So it is your mortgage, it's your line of credit, it's your credit card, it is your debit card, all in one space. It operates like a line of credit, so you don't have a fixed mortgage payment. You have a minimum interest payment every month that comes out against it, and it can be compartmentalized as well. So you can break it down into different compartments, which is great. It's just another mortgage product, but what does it do for us as far as real estate investors? So to have value in your portfolio needs to do these 4 things. Wow, turning it over to here really throws off how stuff lines up. Sorry, it's good to know. So the 4 key things for getting value is flexibility, cash flow protection, interest savings, and equity growth. So if you want to grow your portfolio, these 4 things need to be part of your system to make it work. So how does it work with the Manulife One? Yeah, it does weird things. Sorry, it's really throwing me off. I'm neurotic about details. So the fact that corners are fuzzy and stuff is different really throws me off. My wife gets over it. So flexibility. The key with this product is that you can move quickly. If you have, for example, 4 different properties and you have $20,000 available equity in each property, and you need $80,000 for a new property as a down payment, what's your typical practice? You have to refinance 4 properties. That's a lot of work, that's a lot of monies, that's a lot of fees, that's a lot of headache, and if you need to move quickly because it's a short sale or something like that is going on, that doesn't happen. With this type of product set up on your rentals, it's a line of credit. That money's there. It's talking about transferring money from one account to another, no refinances, no movement, no anything, and the money's there to go. It's that quick, you can buy your next property, and it allows you to move quickly with that process. The big one that we were talking about earlier, which is huge, is cash flow protection. COVID-19 gave our tenants that ability to decide they did not want to pay rent, which hurt a lot of investors because you have a $2,500 a month mortgage payment, which was fine when you were getting $3,000 a month in rent, and now suddenly you're getting $0 a month in rent, but unfortunately the bank still wants their $2,500 a month. So that did a lot of damage to real estate investors, especially new real estate investors. They were forced to sell their portfolios, cash in their savings, cash in investments. With this product, because it is a line of credit type product, there isn't a fixed payment that comes out every month. You have your interest only payment like a typical line of credit, but if you have room on your line of credit, it just rolls over. So if there's $100,000 available on your line of credit, your balance can just keep going up. So for that 2, 3, 6, 8 months that you're working on it, it allows you that protection to not have to sell the property, to get through the however many months it is to get to the committee to try and evict the person, or just your typical vacancy rate, to not have that hitting you every month as a payment, which again, if you're protecting your cash flow, it allows you that opportunity to get through that bump and get out the other side. Interest savings is a huge one, especially when we're all just talking about interest rates and how much interest you're paying. If you refinance your mortgage and you look at how much is interest and how much is principal and how long you're paying so much interest before you really do anything to your principal, this becomes a really big thing. Most mortgages are the interest is calculated semi-annually. So if you put $20,000 on your mortgage as a prepayment, it doesn't really do a whole lot for you. Plus you can't get that money back. This product is done daily. So if you put $20,000 on that line of credit, you're paying $20,000 less of interest.
Wow.
And it doesn't seem like a lot, but over the lifetime of a mortgage, you see investors pay off their properties in 10 to 12 years instead of 25 years with this, because every little bit is going towards it. And that's where we get to equity growth, so rapid equity growth. So a lot of investors that set up their properties correctly will have a second and third bank account, which will be their emergency fund, possibly their property taxes, sometimes first and last month's rent, all set in really boring low interest savings accounts, because you're going to get almost nothing in savings for them because you can't lock them in. Because the moment the tenant decides to destroy your hot water heater or your furnace, you need that money available. So you can't lock it into something that actually gets you good interest. With this product, that account doesn't exist. That $20,000 savings account goes on the mortgage. And when you need it, it's there, you just pull it back out. And for that time that it's sitting there, you're not paying interest on that $20,000. And if you look at your mortgage and your savings account, you pay a lot more interest on your mortgage than you're ever going to get on your savings account. So it keeps it all in one place, and that allows you, again, just to pay that equity down faster. If you have $20,000 set aside for 4 different properties, that is $20,000 less interest times 4 properties that you're paying with your portfolio. It allows that equity to build, less interest to be paid, and continuing to just build. And this piece I love because most people get into this not because they're accountants, they hate accounting. So if you do your own accounting, it's a huge savings. If you pay someone to do your accounting, it's a huge savings because you don't have to pay them to do it. The beauty of this product is your bank statement is your profit loss statement, all in one spot. You get your mortgage statement, which is everything, because you will actually get a physical debit card for that account. So you'll have, say, $900,000 available on a $1.2 million property, and you're gonna have $700,000 owing on it. So you have to be smart with it, because you don't wanna give it and go get a $70,000 Gucci purse, because that money's there on a debit card, or go buy a nice boat, because your buddy got one, but that money is there. So when the tenant, like we said, blows the hot water heater, you go, you pay it. You gotta go pick up salt because it's decided to be icy as hell outside. Perfect, use your debit card. And at the end of the month, all of your expenses are in one spot. With your mortgage payment, with your rent, everything is in the same place. And every little bit of that goes towards the interest. The really cool part about the way this product works is any money that's in there, even if it's only in there for days, saves you interest. So if you take in your rent on the 1st and you pay your mortgage on the 15th, every month you save 15 days worth of interest. Even if that money just goes in and out, it's 15 days you save interest, which over the lifetime of a mortgage makes a huge difference on how quickly you can pay it down. And that's all we care about. Because the faster you pay down that mortgage, the faster either you don't have one, or most of us in this room, you pull that money out and go buy another one. And you do it all over again. Because if we all wanted one property, we wouldn't be sitting in this room. That's the whole key. The other things that it does, which is really cool, you can lock in payments. They're called sub-accounts, like we talked about at the beginning, which helps you track things. So you need a new roof on your property, and you want to have a set payment to see what the payback is. You pull $50,000 out, you do your roof, you can lock that in like a typical mortgage. There's no fees, there's no process to that, it just locks in at a set payment, and a set payment will be due every month for that piece. So now you can track that expense to say, hey, the roof cost me this much, this is how quickly I want to pay it down to follow it. Where that makes more sense is when you start using it for different things. So if you have a Manulife one on your home property, there you go, 10 minutes, I'm on time, good. If you have a Manulife one on your home property, and you need to pull out $200,000 for a line of credit, but you want to be able to write off the interest because it's an investment property. You can lock that $200,000 into a fixed term sub-account. It will have a payment every month, and now you can tie it to that property. It's easy to follow for accounting because it's its own payment, it's its own interest. It'll have its own amortization schedule. So it's easy to tie that for accounting to use the interest and use everything you need for that property. Same like we said with the laneway suite. You want to pull $400,000 out and build a laneway suite, which would be really tiny because everything's so expensive these days. But hypothetically, you could build one for $400,000. You could take that money out, lock it in, and now the rent from the laneway suite goes specifically to that mortgage payment and allows you to see, can you cash flow it? Does it make sense? Does it work? So just some of the simplified accounting stuff for it. And then who does it best work for? It's really neat because a lot of the products we have work in one of these three spaces. So as you start out, we've got a product for you, but once you get to a decent sized investor, it doesn't work anymore. And once you become a legit high scale investor, it doesn't work for you. But the Manulife one really works well all along the way. So at the beginning, as a first time investor, it's perfect. For your owner occupied house, you finance it, you have the money there. Alex finds you a place, oh my God, it falls through. Now you have $300,000 sitting there that you're paying mortgage interest on for 6 months until you find the right property again. With this, that money is just sitting there on a line of credit. Until you use it, you're not paying for it. So it allows you, like we talked, to move quickly, and you can separate it like we talked about. Any expenses for that rental property can be sectioned off into its own account. It gets tricky into layers, but it's easy to figure out once you see it all, and then you can account for interest and all those type of things. It works well for multi-door investors. You can have up to 7 units, 5 rentals, and 2 owner-occupied, and it's units. A lot of our investors are doors, not units. So if you have a 4-plex, that counts as 4 doors. With Manulife, that counts as 1 unit. So you can have 5 4-plexes, and that still works with them. Whereas some of our investors will have a 10 or 15 door limit. So depending upon the mix of your portfolio, you will end up running out of ability to use that lender because of what it sets up as. So with them, 7 units allows you to really maximize the number of doors you have per unit while still using a system like this. And then finally, once you get full blown and get into the holdco space, unfortunately they won't do holdcos yet. We're trying to bug them like hell to use holdcos, but they also won't count what's in a holdco. So you can have 7 properties and then have 3 more in a holdco, and you can still use this product. Those additional units that are in a holdco can't be through Manulife, but you can still have them. Whereas a lot of lenders have a dead stop on the number of properties you can have globally no matter what. So even if you had 10 and you're only using 5 with Manulife, a lot of lenders will say, no go, can't have 10. You can only own 5, they'll call you a commercial landlord, and you've got to go to the commercial space for financing. So with them, they'll allow anything that's in a holdco, they don't care. As long as it's in the holdco, it's fine. We can still do your owner occupied and your 7 units. So that's kind of the general, this is the pitch. This is what I do, residential and commercial. These 2 pieces are kind of the most relevant to everybody in this room, portfolio analysis and reinvestment planning. So I work with a lot of investors where we look at what your setup is and see what we can do to make it work. Sometimes what you have set up is exactly what needs to be done. Sometimes there's ways we can tweak stuff, different products, different setups to make a better cash flow situation for you, especially now with interest rates being kind of funky how they are. And then the big one is reinvestment planning. So figuring out when can you invest again next. Because it's kind of like what they say with all the younger kids getting tattoos. Once you get one, you want another, and it becomes addictive. This industry is the same way. Once you have your first property, you start itching, and you need the second one, and then you need the third one, and then you need the fourth one. So that's what we work on, is, okay, you have 3 properties, this is what your cash flow is, this is what we're looking at. Realistically, when can you start shopping for number 4? And if we get number 4, realistically, when can we start shopping for number 5? So that you know when your next fix is coming and we can go down the road like that. And then market watch, this is what we do for a living. We listen to the Bank of Canada reports, we listen to all this boring garbage that none of you care about, so that you don't have to. Some of you do, but that way you can come to us because this is what we do. We study all this stuff and can kind of give you our opinion on it. And that's pretty much it. If you have any questions, that's my contact card, it's my QR code on that side. On the right-hand side is the app that we use. So if you like to do a lot of your own playing with numbers, you can download that app. It lets you do mortgage calculations, prepayment calculations, land transfer tax calculations, all that stuff on the app that lets you kind of play with your numbers and figure it out yourself. Yeah, and that will throw you my contact card. Any questions?
Thank you so much. We can take a couple questions, yeah?
What's the interest rate on the HELOC for the 900?
And it depends. Right now, I think we're just over 7.
Prime plus.
It's prime plus 2.5 to prime plus higher than that, depending upon their product. So they have 3 main versions: the standard Manulife one, they have the small business owner one that allows us to use business income, and they have an equity advantage, which allows us to lend strictly off the equity of the property. But it's not. A lot of the reason why people avoid this product is they compare it apples to apples. So they will look at this and say, okay, say it's 7.34, and they'll look at a TD product or a Scotia product, just because you're in the room, and TD will beat that rate by 2.5%, 3% or basis points. So they'll be 6.9, and they'll look apples to apples and go, well, why would I go with a Manulife? They're 50 basis points more expensive. But it's how the whole product works. It's the fact that it's an interest, all that stuff, the way it compounds, the interest isn't the same. You're not comparing the rates equally, and that's where their online calculator, if I had more time, I'd go through and show you it all, but you can go on their website and do their calculator, and it's insane how much more quickly you can pay off your mortgage. Obviously, you have to be smart with money and cash flow positive. If you're cash flow negative, it's not gonna work for you. But if you're smart with your money and you're cash flow positive, every extra penny you get in there pays down interest and pays everything off faster. So it's, yeah, it is a higher interest rate than you'll see on other combined mortgage line of credit products, but it's not a true comparison because of how the product works.
Sure. What's the max LTV you can get on this product?
Again, it depends on the 3 branches. So you can get up to 80, but you'll have to lock in anything beyond 65.
Okay.
That's because of the government. So the government won't allow us to have home equity lines beyond 65% loan to value because they think we're all stupid and can't manage our money. The way Manulife works with it is what they'll do is that you have to lock in 15%. So if you want to go to 80% loan to value, but still have immediate access to that money, you don't have to pay it down to 65%, you just have to lock in 15% of it as a fixed term mortgage. And that allows the remaining 65% to be immediately readvanceable. Whereas some lenders will make it that you actually have to pay from 80 down to 65 before you have access to that money again.
Yeah, very unique product. The only thing I can compare it to is Scotia, but
Yeah, it's close to the flex line that Scotia has.
yeah.
The difference is that, Scotia's trying to do it, but the ability to have everything in one spot is where you really get the value. If you use this just like a mortgage, there's no point using it. You use this as a mortgage, a bank account, and everything, because every single dollar, if you're using it personally, your paycheck goes in here, every single penny you get goes in here, and whether it's there for a day or 3 weeks, that pays interest down. If you're doing a rental property with it, this is where your rent goes, your first and last, everything you get from that property goes in there, so it's constantly cash flow positive, paying off more interest.
It's a good product for Smith maneuver, if somebody's familiar with that.
Yes, it is a good product for the Smith maneuver as well. Which is a whole different conversation. So
Awesome. Thank you so much, James.
no problem. Thank you.